Hello, this is Martin here from seekedge, the channel for learning about trading and investing. Welcome again to another brand new episode of the technical analysis series of videos that we have been publishing. And today we're going to learn about a very simple, very popular, and very effective trading strategy based on Bollinger bands. Right? We are going to learn how do we do volatility trading using Bollinger bands. So let us get into it and try to understand what is volatility, right? So this video is meant for basically beginners, right? And if if you're an expert in statistics, or if you're already into data studies, you may find it very basics. That's what we are just quickly touching upon that just to understand what is volatility. So volatility, in order to explain that, we have to always explain the normal distribution of data, right? So there is something known as Galton board. Actually, you can Google and YouTube and all this. You get a lot of videos based on now what is normal deviation, bell curve, and all that. So there is a Galton board experiment that was done by researchers. So this Galton board, always found that this experiment always found that many things in the real life, many things, right? Be any kind of measurements of data, right? They follow a natural order of a normal distribution, right? So Galton board experiment was conducted something like this. What you see here, it's a series of pins, and a ball is put on the funnel, and it goes through all these pins and finally drops into different bins on the bottom, right? So when it was expected to be random, right? So the ball is put randomly, and it will take a random path each time. It may go through different paths and finally comes into and falls into different bins. So it was found that it follows the natural order, and most number of the balls fall in the middle bin, the bin in the middle. That is the fundamental of the experiment. So this is known as normal distribution, right? So bell curve is the curve, is the graph that we plot it based on the data that we get, based on data analysis of normal distribution that we do, right? So what it so this graph that you see is known as, it's in the shape of bell, so it is known as normal distribution curve or bell curve. So what you see here is the most frequency of the data would occur in this middle section. Suppose you are measuring the weight of certain weight or height or of certain group of people in a class, right? And it's most likely that most of them would be in the most number of six. So according to this 34.1 and 34, so 68% of the people would have a weight of say 40 to 45 range. Some of them will be overweight, which will be falling in this 13.6 on, and some of will be underweight, which will be falling in this 30. So that together, if you see, it's 95%. So, and there will be some people who are very thin and very fat, right? So they will fall at the extreme left and right side, right, of the graph. If you try to plot the data from the different frequencies of different kinds of data. It can be any kind of data. It can be the weight, the performance of students or employees, or it can be it can be any kind of data reports. Right? So the normal distribution is a probability distribution. So that is symmetric about the mean, right? Showing that the data near the mean is more frequent in occurrence, right, than the data that is in the firm. So why do we need to plot the data? Do the experiment and plot the data, analyze the data, and put it in in a bell curve form. We need to so the purpose of that is to find the probability of the occurrence of that what you are trying to measure, right? So how much probability is there that so this study will help you to understand how much probability of occurrence of this scenario is there in this, what percentage of probability is there. So this helps you. This is the fundamental of the statistics basics. So the mean is a central section, right, and where the maximum values are concentrated. That data is spread out on either side, which is known as standard deviation. right? So normal distribution or the bell curve analysis data says that 68% of the observations of any kind of data, whether height, weight, performance, price, whatever, right? 68% of the observations of the data are within plus or minus of one standard deviation. So deviation from the mean. Mean is a central point, the average, right? So 95% are within the minus 2 standard deviation and plus 2 standard deviation. But 99.7 are so that is a fundamental of statistics for study of the data and trying to plot the norm. So what is it, right? What is it related to volatility, right? So volatility is the from a finance point of view, from a trader's point of view, it is the fluctuation of the price movement from the mean, right? What is the spot price of Nifty now, and what is the likelihood that it will move from there this week or this month or this year, whatever, what probability. So if you're trying to plot the price data, and form a, you can find that it is most likely that the most number of the deviation from the central price point would be very less most scenarios. But when a black swan occurs or unexpected budget or election or some kind of things occur, then the price can deviate very much far, right? So when we try to analyze this data and plot it graphically, we understand that most 68% of the price movements will be in the one standard deviation, right? On the left, it will either move up on the left 68%, 30%, 34.1% or 34.1 on the other side. The price could move either of the sides. Most of the time, it will be one standard deviation. Certain extreme movements can happen. So volatility of the price can happen if there is. So that occurrence is again 13.6. So very extreme scenarios, huge volatility. So this is how we use the normal distribution curve for volatility to understand the volatility of trade. So it is applicable for all. Finance, we use it for plotting the price of the stock, right? And farther the price moves, likelihood that it is undervalued. So this is the fundamental basis out of which the Bollinger Band is built. So Bollinger Band is an indicator, a tool that is used to help the traders do the better trading. It was developed by John Bollinger in the 1980s, based on the normal distribution and the standard deviation concepts that we had earlier seen. So it is plotted by technically, don't need to go. You can find it, Google and find the calculation if you are using it for some coding purpose. But otherwise, it's a set of trend lines plotted, two standard deviations, positive and negative, away from the moving average of the price. Right? It is plotted as at the standard deviation level above and below the simple moving average price. Is the simple expression. Right? So basically, it consists of an upper band. What do you see? This is the Nifty that is plotted. An upper band is there, which is plus 2 standard deviation. Lower band is plus 2, minus 2 standard deviation. The middle is the median. By default, Bollinger bands settings are that, right? And the market is more volatile, bands widen. Right? This is called a volatility contraction. Widening is known as expansions. Volatility is impact. So from this last 25 weeks or something, or so last 2 months, we had been, the volatility has been constant. The mean the deviation from the central point was very less. Now when it is expanding, the deviation from that is increasing. So based on this, so this is the use of band. Volatility band helps you to plot the price movement and give us a context of what is happening there. How much of volatility, price movement from the mean is there happening or not. This is the tool for that. Now, to put that, we'll see the charts later. I'm just showing. So the default setting is what is being used. Right? We get it by just typing the indicator and then choose the first one. Default setting is 20 and 2, and then you can, in the middle value is the standard 20 simple moving average, right? Middle band. The upper band is plus 2 and minus 2, right? So default setting, you don't need to change anything. Certain concepts are there, which you need to know about Bollinger bands. One is another skews. Skews is nothing but the contraction. What you have seen in the previous graph, same. It is explained in detail here. It gives a potential trading opportunity. How would it give? It could be depending on if it is price is contracting, it is very likely that it will explode. That's what is skews. So it will explode which side, either of the band sides it can explode. Similarly, if it is exploded and it is moving very far away from the mean, it is likely that it will revert. So mean reversion concept can be well traded with the Bollinger Bands. Walking on the bands is what you see, the price moving on the bands, either down or up. So volatility divergence, we'll see that in the charts, you'll understand. Right? It's a price slips outside the band once and then relate to the and then the volatility will increase, and then the volatility will decrease and the price will increase. So there is a divergence. This is similar to the W pattern and the M pattern. We will see that. So that also gives in a long or a short opportunity for using the volatility. So that is one. So this the last one is taking support and resisting on the median. So sometimes the price moves up and walks over the bands and moves up the bands, and then it will mean revert, and it will retrace and then come and then mean revert to back, right? So that is an opportunity for for some traders. So these are different ways. So the breakout is an opportunity, right? The trending up move on the bands is an opportunity. The divergence between the price and the volatility is an opportunity, and the price taking support at the median of the volatility band is support, or that is also an opportunity. So different ways, this can be traded in different ways, right? With a combination of different in other indicators like momentum indicators like RSI or right, and the different price patterns. So it works on all time frame. It works very good in the lower time frame, the shorter time frame. It works intraday beautifully, right? We can try to see some of the occurrences. It works on the daily time frame, works on the weekly time frame. It can be used for positional trades, swing trades. It can be used in intraday trades. So such a powerful and effective tool it is. So this is the concept that we talk about skews, right? So you can see that this is ICA banks, the price is skewing for a long period of time. This is a daily candle, and then it is now skews is breaking out or spilling out, right? So you just have to draw trend lines on, or box patterns on this, and then whenever the rectangle or the trend lines breaks, immediately take the trade with a strict stop loss on the neckline, and then ride the trend following, right? That's bands. Walking the bands is like trend following again, right? It never deviates and comes to the downside of. It keeps moving up, continuously in the straight line. On we can see that is happening, right? Until it retraces back. So this is the period, the moment you have a skews breakout along with the walking bands, it becomes highly effective trade. Now here you can see the positional trades using. Positional trades also can be taken. So we talked about taking the support and resistance. So you can see that this is a Bollinger Band. This is trying to move up and resisting at the median. Again coming down. Trying to move up, resisting at the median. So you have to think that this is 1 week, one full week. Right? 1 week considers 5 trading days. So the moment you see that there is a resistance that is happening on the median of the Bollinger Band, that is the time for you to take in lower time frame the trade daily. Hold it for 2-3 swing days and then come out of it. By the time, beautifully how you see the 4, 5, 6 weeks it went out. 6 weeks is 65, 30 days. How much of percentage might have moved. So that is positional trade. So this median, so whenever it is taking support, sometimes it may be, so here it is resisting at the median. Here you can say it is taking support at the median and resisting at the momentum. So this is a combination of that. So the RSI momentum, what you see here is resisting at the 60, resisting again, resisting again, resisting again. Same time here it is supporting. So when the price moves up, it goes up to the 60 when it dips. So you have to look at the momentum, the candlestick patterns, and the Bollinger Bands combination of all of this. This will give you positional trades. So intraday also this applies. Now there is another concept that we already seen, like skews walking the bands, resisting. One more we saw is volatility divergence. So this is an example for that. You can see that here where this arrow is there, the price has gone outside of the Bollinger Bands, and then it moved up, and then it again formed another bottom inside. That means the volatility decreased. Here the volatility increased when it went down. So whenever volatility is increasing, price is increasing or decreasing, right? Either way, right? For option, so options put and call, it may be always increasing. Option premium increases when the volatility increases, but price wise, if you see, you can see that it has come down, gone outside, and then inside, forming a double bottom, which is a W pattern, and you can see that the big move happened, right? Here it is not such a big move, but actual case it can be much more bigger, but this is more than enough, right? So that is the outside, inside. So this is the divergence between the price and the volatility. Price dips and volatility goes there, increases, or the price decreases, volatility increases. So this forming along with the pattern. Now this is a trading strategy as such. This concept itself is a trading setup. Now that's so that is all the basic concept of Bollinger Bands and trading. Now let us try to quickly there's not enough time here to wrap up in a small period of time. Try to quickly see how SQs one way of trading. So all these we have seen the SQs breakout, right? So that can be traded in options, it can be traded in futures, it can be traded in cash, it can be traded in currency, it can be traded anywhere, any time frame, in a daily, weekly, monthly, anywhere. So this is can be used as a mean reverting strategy, or it can be used in a trend following, or a breakout strategy. So it can be any of those. We already seen how it can be used in positional. So what we are trying to do is now I'm randomly going to do this. I'm not prepared. The other screenshots that you've seen here are screenshots that I picked up and pasted there when I found something. Now I'm going to the charts straight away and see if is there any possibility or not, right? There may not be in the chart. No, I'm randomly picking. Please keep that in mind. If you get something good, right, it'll help you to understand better seeing it on the charts. So, and this is interesting outcome. So, let's take randomly. I'm picking Infosys charts once again. So this is what you can see that. So we are trying to see if there is any concept that we learned is there yet. See, walking of the bands, right? This is a lower time, 15 minutes. So you take the trade here. This is a daily candle. If you're taking it on a, if you take put it, all you have to do is short-term trades on 15 minutes. We are talking about, right? So we understood that there is some kind of consolidation happening. We draw the trend lines here, and then the moment you find that there is a breakout that is happening, enter and then ride the trend till it goes. Trail your profits. That's one setup. This is a walking on the bands example, right? Now let us see if we have any other concepts that we have learned that we can see here. This is outside, so inside. Formation double top, double bottom is not coming, and we'll have to do it quickly. See, this is some kind of double pattern. So yeah, so we'll find a better example for that. Yes, this is a M pattern, right? It goes outside the Bollinger Band and then forms the other top on inside the band, and then look at the fall that has happened, right? Big fall downwards. So this is an example for it. So how do you enter the trade? Right, the moment you see that there is so this is 15 minutes we're talking about, right? So the moment you see that short term, let's go into the long term. The positional trades, right? So we continue to look out for this one trend, right? So the more number of charts that you see, the more it will be visible, right? Yeah, so this also is W. You can see that you can see the W here. You can see that just taking brush, you can see that it fall outside and then form second inside, and then look at the move, boom, right? Neckline. So that is so the target will be double of this W's width. So that's what volatility divergence trade is all about. Let's further continue to look out. So this is actually kind of walking on the bands. You can see this is walking on the band, right? we're just looking at one stock. Each stock has its own personality, its own, you know. So this is a skews breakdown, right? Just been consolidating. It's not big skews, but sometimes it will become very, very, very evident, right? And so since it's a recorded video, it's very difficult to find. So this is how you trade. So this is another. So you can see that it is taking support at the bands. Let's take another ITC. It does not move much, not very volatile. So see, look at that skews breakout, right? Look at the move. Look at the move, right? So if you take a trade here, drawing a trend line, and the trend line is broken, look at the move. It's all walking on the bands, walking on the bands. How much a point is that, right? Look at the points, right? It's 85% on SPI. That's it, no? Because volatility suddenly has expanded after a skews, right? So you'll have to identify the skews and put a trend line here and then take the trade. So skews we have seen, divergence we have seen, and it's only positional that we have to see there. Let's see if positional, what we have to do is, yeah, this does not have positional data. Let's go to ICICI Bank. That is not seems to work. That's why I always have this, right? Let's enable the totality. I'll just, yeah, so very good example reason is this position. If you take, see, you can see the skews here, the skews here, right? The entire area is the skews and it just break out. So it's a trend following positional strategy actually if you're trading Nifty futures, right? Now I just wanted to show some mean reverting strategy also. Let's see if we can get that on ICICI Bank. Let's pick up ICICI Bank and see. So it's basically what you have to look out if, right? So this is kind of, look at that move, higher high, higher low. So it is taking a support at the Bollinger bands, right? And then it's going up. So the moment you see that it is taking a support from this week, Friday, Monday, if you take a trade on top of the high of this candle, look at how much you get, right? 4 weeks of ride, right? So that is swing trades, how it is used on the upside. Similarly, you get sometimes beautiful on the downside. Look at this. So this is also known as drive strategies, multiple drive strategies on Bollinger Bands, right? Look at this, resisting, 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 right? This, imagine that this is weekly, right? So when the week on a Friday evening, the moment you get that this is breaking below this, if you take a trade, you get. So these are all positional opportunities, right? Only thing is, we look at the candlestick or the RSI momentum, and then identify whether there is a support that is being taken in the band or a resistance on the weekly on Friday. Monday you take the trade on the upside, right? That's what you have to do, right? So I hope this helps. You take the trade on using the Bollinger Bands, right, to trade well, and so that's all I have. So this is very effective in all time frames, and we should definitely try it out, right? So with strict stop losses, if you try, it gives very beautiful results on all time frames, especially in the day. It gives multiple opportunities during the intraday, the shorter time frame, right? So this is a 15 minutes time frame that we are talking about, right? So it gives multiple opportunities, right? So let us see. So I'm just randomly taking this, not finding any good option. See here you have a skews and then it's a gap, so it's a breakout. The voltage is expanded. So the next day blindly you can take this trade at with the stop loss at 650 at the bottom of this candle, and you can ride the trend intraday. Right? How much point do you get? Right? It's 2% of trade. So intraday also it gives beautiful trades. I hope it helps. And just to wrap up, we'll quickly go through, since you've gone to the charts, we'll quickly go through the concepts also. Once again, quickly. So we have the skews, which is used for breakouts. We have the walking of the bands, which is used for trend following. Whenever there is a continuous continuous movement of the candle very close to that band, and then positionally you look at where it is resisting at the median at the mean, and then take the trade accordingly. And for divergence, look for the W pattern combination. Is it going outside the band and coming inside or not? Right. So these are the four concepts that you learned, and strategies that we can apply for anything. It holds good for anything. You take a USD in options, it works beautifully on the expiry day. Whenever there is a gamma effect that is happening, you can trade it beautifully. Skews breakout, right? Wait for the 15 minutes charts. Go to the options chart, and watch out for the skews breakout to happen after it drawing a rectangular trend line, and then you trade the profits. That's how it works. So if you like it, hit the like button and share it to maximum people. And that is the only way that helps us to keep motivated and keep coming out with more strategy specific videos is what I'm planning to do if I get more subscriptions, right? Because each of the strategies would need detailed step by step, like what is entry, what is exit, what is stop loss, how do you trail, how do you pyramid. So I'm trying to come out with videos like that, but I need more subscriptions, so please share, and then help me out on this, motivate me, right? Basically, it doesn't cost you anything just to click a like button or share. Thanks a lot, and happy trading and happy learning.